Meet Jimmy. Jimmy is 22 years old and he wants to invest in a company he believes has a huge potential to grow. He does his research and decides to buy shares of a company called FutureTech, currently trading at $10 per share. But how does Jimmy's money actually turn into a stock ownership? Step 1. Placing the order. Jimmy opens his brokerage app. This could be something like Robinhood, Fidelity, or Interactive Brokers. He searches for FutureTech and sees two options. First is market order, where he can buy the stock immediately at the current price, or limit order, where he can set a price he wants to buy at and the order will go through only if the stock hits that price. Our Jimmy decides to use a market order because he wants his trade to go through instantly. He enters 10 shares at $10.10 per share and confirms the trade. Step 2. The broker sends the order. When Jimmy clicks buy, the broker doesn't actually have the stock sitting in inventory. Instead, the broker sends his order to the stock exchange, where all buyers and sellers are matched. Okay, step 3, the stock exchange matches the order. The stock exchange has a list called the order book. And no, don't imagine an old dusty library book. It's not even a physical book at all, but rather a constantly updating digital list where all buy and sell offers are recorded. At this moment, the lowest seller is offering shares at $10.10. So Jimmy's order is matched. And now he owns 10 shares of FutureTech. If demand were lower, Jimmy might have gotten in for $10.05 or even just $10. If demand were higher, the next available seller might have been at $10.20, meaning Jimmy would have paid slightly more. And once the transaction is complete, his broker confirms his purchase and he now officially owns part of FutureTech. Congrats, Jimmy! We are very proud of you. Okay, step 4. What happens to the stock price? Now that Jimmy has bought 10 shares, what happens next? If more people want to buy FutureTech, the stock price goes up because sellers increase their prices. If more people want to sell FutureTech, the stock price goes down because sellers lowers the prices to attract buyers. For example, a few months later, FutureTech gains media attention and suddenly everyone wants in. The stock jumps from $10.10 to $25. Jimmy's $101 investment is now worth $250. Step 5. Selling the stock. After a few years, Jimmy believes FutureTech has reached its maturity stage. It's already huge, and while it will still grow, it won't likely double or triple anymore. So he decides to sell his shares. He goes back to his brokerage app and he places the market sell order. And just like before, the broker sends the order to the stock exchange where buyers are waiting. If demand is strong, he sells at the highest available price. If demand is weak, he might have to sell slightly lower. His order is matched at $50 per share, meaning his $101 investment has turned into astonishing $500. He just made a 5x return. But hey, there is one more way to make money on the stock exchange: the short selling. Now, let's say Jimmy thinks FutureTech is overhyped and its stock price is about to drop. Instead of buying, he can try short selling, which is basically betting against the market. And here is how it works. First, Jimmy borrows 10 shares of FutureTech from the broker and immediately sells them for $50 each. He doesn't own them, he's just borrowing them for now. A little later, FutureTech stock crashes to $20, just as Jimmy predicted. Smart guy. Man, I have to call him. He then buys back 10 shares at $20 per each and returns them to the broker. But since he originally sold them at $50 but bought them back at $20, he pockets the $30 difference per share, making a total profit at $300. But don't the simplicity fool you. Short selling comes with a big risk. If FutureTech stock goes up instead of going down, Jimmy could lose a lot of money. Unlike regular buying, where the worst you can lose is the amount you invested, short selling has unlimited risk because a stock price can, in theory, keep rising forever. That's why short selling is only for experienced traders who knows how to manage the risks. Which brings us to the biggest stock market myth. Is trading just gambling? A lot of people say the stock market is just a casino, but that's only true when you treat it like one. If you're randomly buying stocks, chasing hype, or making decisions based on gut feelings, then yes, that's basically gambling. But the real investors don't just bet, they analyze, they study financial reports, market trends, and company strategies to make informed decisions. Think of it like this. Buying stocks without research, yeah, that's like picking random lottery numbers and pure luck. But studying companies and investing wisely, that's more like starting a business. You research, plan, and make calculated decisions to increase your chances of success. One is blind luck, but the other is playing smart. But here's the thing, if you don't want to analyze individual companies, you can still invest wisely. This is where something called S&P 500 comes in. It's basically a list of 500 biggest companies in America. Instead of picking individual stocks, many investors just buy an S&P 500 index fund, which means you can own a tiny piece of 500 companies all at once. It's simplest and historically very reliable equity strategy for the long term. Because the best investors don't panic over daily ups and downs. Because in the grand scheme of things, the stock market isn't about timing the market, it's about time in the market. As Warren Buffett puts it, if you're not willing to own a stock for 10 years, don't even think about owning it for 10 seconds. So what do you think about all of this? Are you an investor or still on the sidelines? Please give it a like if you found this helpful, subscribe to the channel, it will really help me, and drop a comment below which topic you would like to see in the next video. Until the next time, bye bye. And psst, hey, don't forget to thanks to Jimmy in the comments, he'll be very happy if he will see this.